This LOS is Describe Behavioral Finance and its potential relevance to understanding market anomalies. Behavioral finance. Behavioral finance examines investor behavior to understand how people make decisions individually and collectively. Behavioral finance does not assume that people consider all available information in decision-making and act rationally by maximizing utility within budget constraints and updating expectations consistent with Bayes' formula. The resulting behaviors may affect what is observed in the financial markets. So investors have cognitive biases and behave in ways that are not rational. So some examples are loss aversion. Risk aversion is asymmetrical. Investors dislike losses more than they like gains. Okay? Herding. Overconfidence. Investors overestimate their ability to value securities. Gambler's fallacy. Recent results affect estimates of future probabilities. So markets, I put in bold here, markets can still be efficient even if investors exhibit irrational behavior. Continuing with some other behavioral biases. Other behavioral biases that have been put forth to explain observed investor behavior include the following. Representativeness. Investors assess new information and probabilities of outcomes based on similarity to the current state or to a familiar classification. Mental accounting. Investors keep track of the gains and losses for different investments in separate mental accounts and treat those accounts differently. Conservatism. Investors tend to be slow to react to new information and continue to maintain their prior views or forecasts. And finally, narrow framing. Investors focus on issues in isolation and respond to the issues based on how the issues are posed. So we'll just do a couple of practice questions to consolidate our understanding. The behavior of investors who put more money into a failure that they feel responsible for rather than into a success is most accurately described as A, escalation bias, B, confirmation bias, or C, overconfidence bias. Okay, the correct answer is A. Escalation bias refers to the investor behavior of putting more money into a failure that they feel responsible for rather than into a success. This leads to the practice of averaging down by viewing the additional purchase as a bargain rather than considering the initial purchase as a mistake and selling the stock. We'll just finish this LOS with one last practice question. According to behavioral finance, observed overreaction in securities markets most likely occurs due to A, loss aversion, B, gambler's fallacy, or C, disposition effect. The correct answer is A. According to loss aversion related arguments in behavioral theories, investors dislike losses more than they like comparable gains. Thus, such a behavioral bias can explain observed overreaction in markets. Just going to finish this LOS with a quick scan of the ebook. So you can see that last question was talking about loss aversion and overreaction anomaly. And you can see I just highlighted there that some argue that behavioral theories of loss aversion can explain observed overreaction in markets. If loss aversion is more important than risk aversion, researchers should observe that investors overreact. Although loss aversion can explain the overreaction anomaly, evidence also suggests that underreaction is just as prevalent as overreaction, which counters these arguments. So again, just finishing the LOS by saying you need to go back and go through the text, read up on some of these little areas, and do as many practice questions as possible. And that's the last for this LOS. Thank you.